What if I told you that every time you buy a kilo of chicken at the grocery store, you are secretly paying a hidden 57 rupee tax?
Yeah, and, a tax that goes absolutely nowhere near a government treasury.
Right. It actually just directly funds a massive corporate monopoly.
I mean, it sounds like a complete conspiracy theory when you put it like that. But when you follow the supply chain data, it's just a cold, hard accounting reality.
And it all starts with this headline that, sounds perfectly innocent, even noble, really.
Right. The government deciding to double the special commodity levy on imported maize.
Exactly. They took it from 25 rupees a kilogram up to 50 rupees. And the stated goal was just to protect local farmers, right? To make imported maize expensive so domestic cultivation would thrive.
Which is a reasonable goal on paper, but, well, when you pull the annual report for the company sitting at the absolute center of Sri Lanka's maize supply chain...
A totally different story emerges.
Exactly. A totally different story about who is actually cashing in on that protection.
Which is why we have to look past the stated intent of these economic policies and look at the operational reality. We have to follow the math.
And doing the math is exactly what we are here for.
Absolutely. So welcome to this special forensic investment deep dive on behalf of Optivest Investing Sri Lanka. We are the forensic investment education channel focused entirely on the Colombo Stock Exchange.
And today we have our sights set on Ceylon Grain Elevators, PLC.
Right. The ticker symbol is GRAN. Now, before we tear into the numbers, let's just lay out the rules of engagement for you, the listener.
Yeah, because we need to be clear about what this is.
Exactly. This is a neutral, analytical, strictly data-driven look at their FY 2025 annual report. We're also using Optivist's analytical summary and a recent Newswire Gazette article.
So there will be no speculation. We are never going to tell you to buy or sell a stock.
Never. Our mission is purely forensic. We just want to figure out how this machine actually works.
And, I mean, the machine we are looking at today is incredibly complex.
It really is.
Our objective here is to uncover where GRAN's immense pricing power truly originates, and to basically map out exactly how a government policy one that was explicitly designed to help smallholder farmers inadvertently handed a massive corporation an impenetrable competitive moat.
Okay, let's unpack this.
Yeah.
Because I am looking at the sheer scale of GRAN. And it just doesn't look like a normal company that out-hustled the competition from scratch.
No, not at all.
Right. Like, when we analyze a company's current tax advantages, we have to look at their DNA. GRAN was incorporated back in 1982, and they certainly didn't start in a garage.
Definitely not. Their origin is entirely state-sponsored. They were constituted through a direct government-to-Prima Limited Singapore agreement.
Wait, so the government literally built the competitive landscape they operate in from day one?
Yeah, that is the crucial context here. When you look at GRAN, you are not analyzing some, scrappy private enterprise in a pure free market.
Right.
You are looking at an entity whose market position and their infrastructure, and especially their import licensing privileges, are just permanently interwoven with the state's agricultural agenda.
So they are basically an extension of that original 1982 bargain.
Exactly. It gave them a structural foundation that, honestly, no independent startup could ever replicate.
And they have used that foundation to build an absolute behemoth. I mean, they don't just do one thing. They operate across the entire life cycle of the industry.
Yeah, the vertical integration is massive.
They have a milling and farming segment, which produces the actual feed. They have poultry breeding. They have commercial operations running the chicken farms themselves.
And they even run CLAS veterinary services.
Right, meaning they control the medical and biological supply chain for the animals. Oh, and they also own 57.21% of 3-acre farms.
Which is a massive operation we analyzed in an earlier deep dive.
Yeah, so they really own the entire board.
They do, and the numbers for the parent company, GRAN, really reflect that dominance.
Let's give the listener the FY 2025 snapshot because it's wild. They hit 29.77 billion rupees in revenue.
Wow.
Yeah, with an operating income sitting at 5.57 billion rupees.
Right. And that puts their margin at an incredibly healthy 18.7%.
Which is staggering.
Yeah.
But those numbers also hide a massive financial contradiction.
Yeah, if you dig into that FY 2025 data, you find something that just defies normal economic gravity. This is what Optivest calls the profitability paradox.
I saw this in the report, and I literally had to read it twice. Let's look at the raw materials they need to keep this empire running.
Specifically maize.
Right, maize. things got wildly expensive for them. Their import dependency, which is the amount of raw material they have to buy from outside the country, it jumped from 30% all the way up to 56% of their cost of sales.
And because of that massive reliance on imports, their import-linked costs just skyrocketed.
Yeah.
I mean, they went from 6.18 billion rupees to 13.08 billion rupees.
That is a 111% increase in their core costs.
Exactly.
And this is where I get completely stuck. Like, if I am running a bakery and the cost of my flour jumps 111%, my profits are wiped out. I am eating instant noodles for a month.
Right. He'd be ruined.
How on earth does a company's core raw material cost more than double, but they somehow get 64% richer in operating income?
Well, under any standard economic model, their profitability should have collapsed entirely. But as you just noted, operating income grew 64%, and their margins didn't shrink, they actually expanded.
Moving from 14.1% to 18.7%.
Right, so what we are observing here is a 2.7x operating leverage.
Break that down for me. What does 2.7x operating leverage actually mean in, plain English?
It means they have achieved the ultimate corporate superpower, full cost pass-through. Yeah, when GRAN faces a massive cost increase for imported maize, they do not absorb a single rupee of that pain. They simply rewrite the price tag on the commercial feed they sell to farmers.
So their top-line revenue artificially inflates because they are just charging drastically higher prices.
Exactly, but their fixed costs, things like their factories, administrative staff, their equipment, those don't really change.
Right.
So a disproportionate chunk of that inflated revenue drops straight down to the bottom line as pure profit.
So they basically use inflation as a margin builder. The question isn't whether they have pricing power. They clearly do. The forensic question is, why does the market accept those prices? Where does that unyielding power actually come from?
Well, it comes directly from the Special Commodity Levy, the SCL.
Right.
The government does that doubled the SCL on imported maize to 50 rupees per kilogram, effective over an 8-month period that triggered two completely distinct effects for GRN.
And the first one is pretty obvious, but the second one is just a masterclass in invisible market capture. Let's tackle the obvious one first, the visible cost pressure.
Yeah, so GRN is importing roughly 73,800 metric tons of maize.
And with the SCL doubled, they're paying an extra 25 rupees on every single kilogram. So over that 8-month Gazette period, that works out to a massive 1.23 billion rupees in gross additional costs.
And, any amateur analyst looking at that 1.23 billion rupee tax bill would immediately panic. They'd assume GRAN's margins are about to be destroyed.
Sure.
But because of their licensed import position and their market dominance, they recover every single rupee of that 1.23 billion in the feed prices they charge.
Okay, they pass the cost on. I get that part. But passing a cost on doesn't explain how they actually grew their market share so aggressively at the same time.
No, it doesn't.
And it reminds me of an analogy from our Optivest sources that I was thinking about earlier, because it perfectly explains how a tax can be used as a weapon against your competition.
The three-wheeler analogy.
Exactly. So imagine a guy who drives a three-wheeler for a living. He scrimps and saves to buy his own vehicle privately, specifically so he doesn't have to pay daily rental fares to some large commercial fleet owner.
Right, he wants to be independent.
He is independent. But now imagine the government suddenly decides to slap a massive tax on private vehicle ownership. But, and this is the crucial part, they exempt licensed commercial fleet operators.
So what happens to the driver?
Well, the driver's math breaks. Owning his own three-wheeler suddenly becomes completely uneconomical. He literally cannot afford the tax.
Right.
So he has no choice. He has to sell his vehicle, give up his independence, and just become a paying passenger in the commercial fleet.
That analogy perfectly mirrors what happened in Sri Lanka's poultry sector. In this scenario, GRAN is the licensed commercial fleet operator.
And the thousands of smallholder poultry farmers scattered across the country.
They are the independent drivers.
So how were those farmers actually operating before the tax?
Well, historically, a smart, independent smallholder farmer wouldn't buy pre-mixed commercial feed from a giant corporation.
Right.
They would buy raw maize themselves, maybe from a local supplier, run it through their own small grinding equipment, and self-mix their own poultry feed.
Which requires effort, sure, but it saves them a massive amount of money and keeps their margins healthy.
Exactly. But then the government drops a 50 rupee per kilogram tax on imported maize.
And unlike GRAN, a small farmer does not have the scale to absorb a 50 rupee tax.
No, nor do they have the pricing power to pass it perfectly down the line. So the moment that gazette was signed, self-mixing became financially impossible for them. They were cornered.
So to keep their chickens fed and their farms running, they just have to abandon their self-mixing operations and sign commercial feed contracts with the licensed giant,
Yeah.
with GRAN.
Yeah, and you can see this happening in real time in the FY 2025 data. GRAN's external feed sales didn't just grow, they surged by 25.7%.
Wow.
And that growth happened in the exact same year that import costs doubled.
That is mind-blowing. The government essentially ran a massive, highly effective customer acquisition campaign for GRN.
Entirely for free.
For free, and under the banner of protecting local agriculture. But wait, if the tax ever gets reversed, won't those farmers just go back to mixing their own feed?
Well, what's fascinating here is the brutal permanence of this shift. Once a smallholder farmer is forced to stop self-mixing, the decay starts immediately.
What do you mean by decay?
Within a year or two, their mixing equipment just sits idle and rusts, or they sell it off to make ends meet. The direct relationships they had with raw ingredient suppliers evaporate.
Yeah.
And the operational knowledge of how to properly formulate the feed just fades away.
So they become structurally dependent.
Entirely dependent. Even if the government were to completely remove the maize tax tomorrow, the vast majority of those converted farmers could never afford the heavy capital expenditure required to buy new grinding equipment and start from scratch.
So GRAN hasn't just captured them for a season. They have captured them for the lifespan of their business.
Precisely.
Okay, I want to follow the money all the way down the chain here. We know GRAN isn't eating that extra 1.23 billion rupee tax bill.
Right, they pass it to the farmers in the form of more expensive commercial feed.
But the farmers aren't running charities either. They have to pass that inflated feed cost onto the market. So who is actually footing the bill for this entire system?
Well, if we connect this to the bigger picture, the data leads us directly to the local grocery store. To understand the true cost of this policy, you have to look at the biology of poultry farming.
Okay.
Specifically, the feed conversion ratio.
Right, so think about how a chicken actually grows.
Exactly. It takes 1.9 kilograms of feed to produce exactly 1 kilogram of harvestable chicken.
Okay, 1.9 kilos of feed, and how much of that is maize?
Maize makes up 60% of that feed by weight.
Okay.
So if you multiply 1.9 by 60%, it means that 1.14 kilograms of maize is physically embedded into every single kilogram of retail chicken sitting in a supermarket freezer.
Okay, I see where this is going. So if the government is taxing that imported maize at 50 rupees per kilogram.
Then you multiply that 1.14 kilograms of embedded maize by the 50 rupee tax. That equals 57 rupees.
Wow. So there is a hidden 57 rupee levy baked into every single kilogram of retail chicken.
It used to be 28.50 rupees before the tax doubled. Now it is 57.
Let's just make that real for the listener. If a family is buying a kilo of chicken at retail for, say, 800 rupees, 57 rupees of that is just this invisible maize tax.
Right.
That is 7.1% of the total price.
It is an invisible consumer tax that never shows up on a grocery receipt. I mean, think about a standard household. If a family buys 2 kilograms of chicken a week to feed their kids, they were quietly paying 2,964 rupees more every single year.
And nobody sees the mechanics of it. The family just feels the pinch of food inflation. The government gets to issue a press release about a policy gazette protecting domestic agriculture.
Exactly.
And GRN just treats it as a raw material cost that they fully pass through while capturing more market share.
It is a perfectly closed loop.
But surely the policy must be working on some level, right? The stated goal was to protect local maize farmers and increase domestic cultivation.
Yeah.
Are we at least seeing a massive boom in local maize production?
Well, the agricultural data is incredibly damning.
Yeah. The SEL has been escalating since 2020. The theory was that as imported maize became more expensive, local farmers would rush to fill the demand. So let's look at the USDA data for Sri Lanka.
Okay, what does it say?
Domestic maize production actually peaked in the 2020 to 2021 period, hitting 107,000 metric tons. That was the highest recorded level.
Okay, so that was before the massive escalations. What happened after they aggressively raised the levy?
Production fell off a cliff. It dropped to 76,000 metric tons in the 2022 to 2023 period.
Wait, they doubled the tax to protect the farmers and production plummeted.
Yes. The estimate for the 2025 to 2026 period is slightly better, sitting at 85,000 metric tons, but that is still substantially below the pre-escalation peak.
And remind me, how much maize does GRAN need just for their own operations?
GRAN's demand alone is 132,000 metric tons annually.
So the entire country isn't even producing enough maize to feed one corporation's supply chain, let alone the rest of the market.
No, they aren't. The production gap is actually wider today than when the levy first began. The policy completely failed its stated objective.
It failed to grow domestic agriculture, yes, but it succeeded spectacularly as a mechanism for wealth transfer. That is the core forensic takeaway here.
Right.
The licensed importer, GRAN, has the scale to pass the cost entirely down the chain, gaining market share in the process. The smallholder farmer loses their independence and their ability to self-mix.
And the everyday family pays an invisible 57 rupee tax to fund the whole operation.
Exactly.
Here's where it gets really interesting for someone analyzing this company. On paper, GRAN looks utterly invincible. They have massive market share, absolute pricing power, and a captured customer base that literally can't afford to leave.
Right.
But from an investment analysis standpoint, is this moat actually sustainable? Because this entire empire seems to rest on a literal piece of paper, a government gazette with an expiration date.
And this raises an important question about how we define competitive advantages. A traditional moat is built on a superior product or an incredible brand or, irreplaceable technology.
Sure.
What GRAN has is a regulatory moat. It is incredibly deep and highly effective, but it is entirely dependent on the stroke of a pen. The current Gazette expires on December 31st, 2026.
And what actually happens if the government changes its mind? What if they don't renew it or they flash the tax rate back down to 10 rupees?
Well, if the SCL is removed or drastically reduced, the enormous artificial cost differential between self-mixing and buying commercial feed begins to evaporate.
Okay.
The economics of self-mixing would start to recover. Now, as we noted earlier, the customers GRN has captured are sticky. Rebuilding a self-mixing operation takes capital, time, and knowledge.
Right. The rust and the lost suppliers we talked about.
Exactly. But they are not completely permanent. If that tax barrier disappears for a sustained period, the larger, more resilient, independent farmers will inevitably find the capital to rebuild their self-mixing capabilities.
Because the margin improvement is just too lucrative to ignore.
Precisely.
Which means the exact same government apparatus that built GRAN's foundation back in 1982 essentially holds the keys to their current growth engine today.
Yes, they have to set this SEL rate every 6 to 12 months.
So if you are analyzing this business, you aren't just trying to predict the consumer demand for chicken. You're trying to predict the continuity of a very specific, highly political regulatory architecture.
The risk profile of the company is intrinsically tied to policy renewal. If that policy framework shifts, the structural market expansion they have enjoyed could very quickly begin to reverse.
Let's pull all the subjective data together. Based on the FY 2025 annual report and the broader market landscape, GRAN holds a licensed, highly privileged import position.
Right.
They have proven an absolute mathematical ability to pass through 100% of their raw material cost increases directly to the market, which we see in their margin expansion and that wild 2.7x operating leverage.
Yeah, the numbers don't lie.
And they are acquiring compounding market share, mostly because a consistently renewed government policy is systematically breaking the financial math for their smaller, independent competitors.
It is a formidable, brilliantly executed business position. I mean, from a purely analytical standpoint, the moat is unassailable for as long as that gazette remains in place.
But this leaves us with a final provocative thought. And this is the core moral and analytical question derived from the Optivest framework.
Let's hear it.
This deep dive is absolutely not an argument against GRAN as a business. They are operating flawlessly within the rules of the game they are playing.
Of course.
But as an analyst or an investor, you have to look at the entire ecosystem. You have to ask yourself, does this competitive moat fundamentally depend on a policy that transfers wealth from regular, everyday consumers buying groceries and from small, independent farmers directly to a licensed corporate entity?
Right.
And if the data says yes, is that a position your own moral ground allows you to hold?
It is a question that spreadsheets and profit margins simply cannot answer for you. It requires looking beyond the financial returns to understand the societal mechanics that are generating them.
And that is exactly why we do these forensic teardowns. We look past the headlines, we ignore the stated intentions, and we follow the data to find out how the machine actually works.
Thank you for joining us on this deep dive into Ceylon Grain Elevators PLC. We read the report so you do not have to guess. Ayubawan Vanakam.